This is a download from BFM.MY, the business station.
Alliance Bank presents you The Breakfast Grill. Top interviews you can't afford to miss on BFM.MY, the business station.
Today on The Breakfast Grill, Paul Schulte, a financial researcher, also author of the book, The Next Revolution in Our Credit-Driven Economy. Paul, later on, we would like to look at how financial technology radicalizes the world we live in. But first, your book asks us to take a closer look at central bank activity to predict when crises can arise. What causes an economic crisis?
The cause of an economic crisis, which is sort of what we're seeing right now, is when a country exhausts its domestic savings base, and that just means that the amount of loans which is distributed by the banking system becomes larger than the savings base of the country, and that's just a very easy to look at number, which is called a loan to deposit ratio. And so when this number approaches 1, you begin to have problems because banks just don't have any more savings to distribute by way of mortgages, credit facilities, small and medium-sized enterprise loans, personal loans, and so forth. And so either they have to stop lending or they have to go outside the country and borrow what we call wholesale from wholesale banks like Standard Chartered, HSBC, BNP, banks like this. And right now what we're seeing in countries like Malaysia, Indonesia, Thailand in particular is that for the first time in 8 years, the credit cycle is coming to an end.
Now, we saw that in the Asian financial crisis, which happened almost 20 years ago, loan deposit ratios actually went above 1 or went above 100%. Did this come from extra borrowing from foreigners, or did governments in Asia print a lot of money?
It was pardon me, it was precisely from international borrowing. International borrowing from Standard Chartered, Citibank, JP Morgan, HSBC, and other banks who were in that business. And so money just poured into these countries, and the loan-to-deposit ratio approached 1.1, and then it was about 1.2. And usually around 1.2, that is when your economy can blow up quite substantially, because at that point, a lot of your assets are already overvalued. You have so much credit pouring into the economy that real estate prices, stock prices, the price of the currency, other asset prices are bloated. They're overblown, and so this wholesale money, which I consider to be quite a dangerous phenomenon, can, as quick as it comes in, it goes out. And that's exactly what happened during the Asian crisis. And what we're seeing today is two things. One is banks like, Standard Chartered, HSBC, Citibank, JP Morgan, they're all under, severe scrutiny and regulatory restraint right now. And also they're just under this sort of weight of problems, especially in commodities. And so there just isn't a lot of scope for lending. On the other hand, central banks locally, the Indonesian central bank, definitely, the Bank of Thailand, I think the Malaysian central bank, Hong Kong, have woken up to this danger of having, loan-to-deposit ratios of 1.2, 1.3. And so they're just saying, what? Well, we're not going to have loan-to-deposit ratios above 1. We're going to live with our domestic savings base or forget it. And that's what's happening right now. So regulators and banks are approaching a natural point of restriction. And that's why, sort of currencies are throwing a fit right now, and that's why stock prices are so sour. The world is waking up to the reality that there just is not enough credit right now to keep this, party going.
Now, we know that credit creation is, of course, the manner from which the economy derives vitality. If governments, especially in emerging markets, can't create more credit, how are they going to fund development?
Well, the only way that you can basically create more savings to create more credit is but you have to trade more. You have to create trade surpluses. And the way you can do that is by, guess what, devaluing your currency. And so right now we see a lot of, currency weakness all around the world of countries who are trying to gain market share by trade in order to replenish domestic savings. Here's the problem. The problem is countries like Malaysia, are renegotiating gas contracts with Japan at very substantially lower levels than a year ago. And so oil and gas, and coal especially being down so much, we have a problem with where do these countries get the extra marginal savings just to cover the hole which has been created by lower commodity prices. That's a problem because you're not talking about extra credit. You're talking about, generating the savings to compensate the hole, a very deep hole, which has been created by collapsing oil prices, gas prices, and coal prices.
Now, Paul, we've seen that the problems in Greece show us how austerity can cause a lot of misery and strife. And I'm going to ask you, is the discipline of the markets the only answer to social safety nets? And I guess this is a pretty big question as well. Sure.
No, it's a great question. I think that market discipline. All this discussion about market discipline and capitalism. A lot of that is just all false. It's false descriptions and false definitions because there's no such thing as a capitalist economy. I mean, America's not a capitalist economy. 40% of America's economy comes from government spending, right? So that just is simply not true. And of course, what's happening in Greece is basically that the IMF, the ECB, and basically the European Commission, the Troika have gotten together and have created a bailout plan for Greece, which is nothing more than repaying the German and the French banks. And so everyone's in this blather about, austerity packages and bailouts for Greece. This has got nothing to do with the Greek people. This has everything to do with making sure that the German and the French banks are, repaid. And so the Foreign Affairs, magazine, which is, center-right, definitely, had an interesting article which basically brought this up. And this is not a lefty magazine. This is a center-right magazine, which basically said this has got nothing to do with protecting the Greek people or offering some sort of relief to the Greek people. This has got everything to do with the IMF and the ECB as sort of a debt collector for, the German and the French banks who lent all this money to Greece 10 years ago.
Paul Schulte is on the Breakfast Grill this morning. He wrote the book, The Next Revolution in Our Credit-Driven Economy, Up Next Technology and the Brewing Financial Revolution, as well as whether there is an imminent financial crash. This morning on the Breakfast Grill is Paul Schulte. He is the author of the book, The Next Revolution in Our Credit-Driven Economy. Now, Paul, by revolution, it's obvious you're referring to how the tech world is causing events of seismic proportions. How does this affect the banking sector and financial services?
Well, right now you have a lot of extremely large banks who are under, tremendous pressure from the attorneys general, from district attorneys, from regulators, and so forth. And these banks are under a kind of siege right now. And anybody who's under siege, whether it's a badly regulated, let me give you an example. If you have a dam collapse, you're going to have, all these water companies who are under tremendous pressure for revenge, for how could you let this happen? And this is what happened to the GFC, right? We had a financial collapse. And so, there's a lot of politicians and regulators who are saying, how can we let this happen? We must never let this happen again. And so these financial institutions are paralyzed in many ways. And while this is happening, they have fired tens of thousands of very talented people. these talented people say, to hell with it. I'm going to go and create, my own, what I was doing in a bank, much cheaper, in a much cheaper way, more efficiently, 80 or 90% cheaper, with smaller amounts of people, with technology that's available to me that was completely unheard of 4 or 5 years ago. And so all of a sudden, you have small groups of people who are getting private equity funding to reinvent, recreate traditional banking activities, which are now available at a price which is 70, 80, 90% cheaper than a bank, more efficiently, easier, faster, cheaper in virtually every area that banks compete in.
Can they become full-fledged banks, though? Alibaba already offers some banking services, and the question is, can the likes of Facebook or Google or Amazon become full-fledged banks?
Well, if you look that's a great question. I would turn it around, and I would say that there was a new financial institution being created in front of our eyes. And I'll give you a couple of examples. Rakuten in Japan, Silver Lake Access in Singapore and Malaysia, Alibaba, and these are kind of quasi-financial institutions, which are becoming sort of a quasi-bank, because here's what's happening. The banks are not aware that the way in which people share and learn and live and spend and fund and search out for ideas about investing and spending are all on the internet. They're all on Facebook. They're all on Google. They're all on Twitter. And people don't go to the bank anymore to figure out what to do with their money. They're online. And so what's happening is these guys are coming along and saying, we're going to create a new environment. We're going to create a new ecosystem which is connected to the social network. Banks are not connected to the social network in so many cases. They don't know how to do that. And so these other companies come along and they create insurance products, securities products, stock investing products, and they glue it on to people's lifestyle choices by way of Facebook, Google, Apple, and so forth. And they create an integrated lifestyle financial institution, which is a new way of spending, investing, and enjoying life. And banks are not with the program on this. And, like I said, Rakuten in Japan, Alibaba in China, Silver Lake Access is doing some really interesting stuff on this in Singapore. And other companies are coming along in Indonesia, right, through the phone. And so the phone becomes a new sort of bank. And the traditional banks don't have the license. They don't have the goodwill of the regulator. They are under tremendous scrutiny anyway. And they just don't have the DNA in many cases of being a large institution to know how to change quickly. But smaller companies can do this.
So what these new financial companies have not going for them is that there are very high regulatory barriers. And one of them is that they can't create money through what is called the fractional reserve system.
Yes, sir. Yeah, that's right. Mm-hmm.
Where banks actually print money and lend out money that they don't have. Do you think that financial, or rather the tech firms, need to evolve towards that kind of direction?
That's a great question. They're never going to be part of a fractional reserve system of a licensed bank. But on the other hand, they are showing themselves to command, payment systems. They are showing themselves to command all the credit card activity. So more and more of the activity on a person's cell phone is being conducted in a non-bank manner. And this is where fees come in, and where companies can make tremendous amounts of money on fees. They can collect money, and they can be a quasi bank, right? P2P, the whole P2P phenomenon, like Lufax, right? Lufax is now a multi-billion-dollar, lender through peer-to-peer lending, and this is going to become a new phenomenon. And so you don't necessarily have to be a fractional reserve, licensed bank to become a very large player. What is the largest marginal player in the UK? The UK banks are all shrinking right now. The largest marginal lender in the UK is Zopa. Zopa is a peer-to-peer lender. The world is changing in front of our eyes.
Yeah, we've actually also interviewed Zopa before, a very exciting company. And a lot of people are actually also investing into gold and bitcoins to skirt monetary systems. Will this blunt the role of central banks?
Yeah, central banks do not like Bitcoin. Right now, there are about 550 Bitcoin-related companies out there. And these companies can have very little capitalization. Let me give you one example. In the sort of the meltdown of the Russian ruble several months ago, one of the top 5 or 6 largest Bitcoin companies in the world is a Russian company, and the turnover on that Bitcoin exchange was larger than all the whole world of Bitcoin trading activity combined. In other words, a lot of people were using Bitcoin as a way to get their money out of the country during the Russian ruble meltdown several months ago. So this is a new world where people say, hey, wait a minute, the Bitcoin is becoming an important thing here as a substitute for gold, as a substitute for diamonds, as a substitute for cash in order to move money around the world, in order to, for various reasons, right? So if they don't feel comfortable being in their own currency, they can use Bitcoin to leave the country and so forth. Now, I think this is going to go nowhere but up. And Bangladesh is one of the first countries ever to create its own version of e-currency. So the Bangladeshi central bank is now one of the first central banks to create its own e-currency over your cell phone, basically. So I think we're pretty much in the bottom of the first inning in terms of Bitcoin, and people who are poo-pooing it and saying it's just not going to happen, I think are kidding themselves.
Paul Schulte is on the Breakfast Grill this morning. He's the author of the book, The Next Revolution in Our Credit-Driven Economy, and we're talking about financial revolutions. Now, Paul, a rise in interest rates is just waiting to happen because globally they are near zero. Is this a rollback? Is this rollback in liquidity and credit creation? Is it going to cause another global financial crash?
Well, here's the problem, right? So, believe it or not, the healthiest banking system in the world is the United States banking system. The United States banking system, in terms of leverage, has one of the lowest leverage levels in a generation. In terms of liquidity, the United States has one of the lowest loan-to-deposit ratios in the world. That's why the dollar's strong. That's why the equity market has held up so well. That's why real estate prices are doing so well. Now, here's the problem. The dollar is also, the Federal Reserve is not just a Federal Reserve for the United States of America from, New York to California. The dollar is the reserve currency of the world, and this is always a dilemma for the Federal Reserve because the Federal Reserve always has to take into consideration the effect of tightening on the rest of the world. I think if the U.S. starts to tighten in a fairly serious manner, I think the world will tip over into recession. Think about it, right? There's no inflation in the UK. There's no inflation in Europe. There's, the producer price measure in China has been negative for 2 years. And the inflation measure in China is 1.5%. There's no inflation in Southeast Asia. The only country that has inflation in the world is Brazil for its own dysfunctional reasons. There's no inflation in the world. And unemployment in Europe is, 12, 13%. And the real unemployment rate in America is probably 12 or 13%. So how on earth can you think about raising interest rates in this kind of an environment? I think there's a lot of political noise in the background that the Republican end of the spectrum wants to raise rates. And I don't think this is going to happen. I think that the world's in a very messy position, so I'm skeptical. The market measures are telling us there's not going to be a rate increase before the end of the year.
Now, but have you looked at, through your research, the conditions by which a crisis would happen? and of course, back tested those kind of movements and compare it to what's happening today, would you say that we are close to a financial crash as a lot of commentators predict?
Well, a financial crash. So here's what I think is the problem. I think the one weak spot is a very large economy, and it is the most overstretched economy based upon historical measures. So if we use those historical measures that you're talking about right now, Brazil is the number one epicenter for a financial crisis because Brazil's loan-to-deposit ratio is something like 130. And Brazil, unfortunately, also has its own, nightmare from hell with oil prices, almost, in the 30s today. It almost broke below 40 today in trading. And so to me, Brazil is far and away the most problematic country in the world right now. The second most stretched country in the world is Turkey. In Southeast Asia, I don't see it. Malaysia, Thailand, Indonesia, they're stretched. They're sort of reaching a tapping out point. But the leverage levels are low, and we're not in any sort of extreme levels we were at, when I was in Hong Kong in 1997.
Muhammad Al-Arian, the ex-chief investments officer of PIMCO, he talks about how markets have placed too much trust in central banks, and he calls this the central bank paradigm, which is about to be broken because central banks around the world do not have the ammunition anymore to provide that monetary and liquidity sugar rush into markets. But the question I want to ask is related to emerging markets with their developmental needs. How can these emerging markets play around with liquidity while also keeping an eye on asset bubbles and things like inequality?
Well, here's the deal, right? I mean, central banks are not owned by the Democratic Party. They're not owned by the middle class. Central banks are owned by the banks. This is the modern structure. Right? The Federal Reserve is not owned by the federal government. The Federal Reserve is owned by the banks. And what do banks want to do? Banks want to protect asset values. So the banks have basically said, the central banks need to buy all this government debt. The central banks want the governments to buy all these assets in order to protect asset prices. The worst possible outcome for what we're trying to achieve right now through all the central bank intervention is deflation. That is why the markets are throwing a fit right now, because the markets are saying, wait a minute here. Central banks have bought $10 trillion worth of assets, and we can't get inflation. Inflation's, approaching 1 or below 1% all over the world, and we're getting a whole lot of nothing for $10 trillion of asset purchases by central banks. How much is that in GDP terms? That is 20% of GDP of the world central banks have bought in the last 7 years. And so Muhammad Al-Arian's point is, hey, this is a problem because we're just not getting the bang for the buck that we thought we'd get with all the asset purchases by central banks. I think we're going to get huge rate cuts all over the place. I think China's going to ease. I think India's going to ease more. Brazil's going to have to ease. I think Indonesia, Malaysia will have to start cutting rates pretty aggressively. And, guess what? I think we cannot rule out quantitative easing by emerging market central banks. Because if it's good enough for the developed world, hey, it's good enough for the emerging world. So I don't think this central bank activity has finished itself out yet.
Paul, we have time for one last question. Where are you putting your money right now?
With my recommendations for my clients, the safest place right now is inside the U.S. equity market. I think we should not be bottom fishing right now in any of these emerging markets. I think September and October is going to bring probably a mini crisis, and I think that mini crisis is going to be spawned by Brazil. So I want to stay far away from Brazil. Turkey's problematic. But I think after that, I think the time to begin to really jump back in is probably after some sort of October mess. And I think we're going to see the Federal Reserve back off of raising interest rates. And so I think we're going to have a little bit of a rally from lower levels right there.
Thank you. That was Paul Schulte, chairman of Schulte Research and also author of the book, the next revolution in our credit-driven economy. I'm Julian Ng for The Breakfast Grill, BFM 89.9.
The BFM Breakfast Grill was brought to you by Alliance Bank. Banking made personal. A total banking relationship that rewards you.
Thank you for listening to this podcast. To find more great interviews, go to BFM.MY or find us on iTunes. BFM 89.9, the business station.